welcome to Mad Money. Welcome to Cramerica and San Francisco. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain, but to put it in context. So call me at 1-800-743-CNBC. How about tweeting me at Jim Cramer? Maybe our brains are too small. Could that be the reason why we can't get our silly little heads around the need to spend fortunes building out the data centers for artificial intelligence? That's what I'm trying to comprehend as I do my deep dive into the tech world in order to help you make the most informed decisions about all sorts of stocks whose fortunes depend on what comes next in Silicon Valley. The averages often depend on who's meeting who and who's spending what, including today. Dow dipped 17 points. S&P advanced 0.4%. NASDAQ gained 0.66%. The latter boosted by, you guessed it, anything associated with artificial intelligence. Yesterday, I did a core dump on Salesforce. Well, it's making a very big push into the enterprise using its own AI. But after CEO Mark Benioff's keynote speech at Dreamforce about his Agentforce initiative, the stock actually got dinged today, falling more than $3. Ouch! Wall Street's skeptical that Agentforce won't matter to the stock until more business comes from it. I don't know if the stock can turn until AI is driving the company's numbers. But what's not in doubt? How about the sheer amount of what we call compute, the juice needed to power Agentforce and every other application of artificial intelligence? In other words, to get a machine to act like a human or smarter than a human, you need to spend a ton of money on the back end with warehouses and warehouses full of servers, making it all possible. And it's the back end. It's the battleground. It's the back end that creates the gating factor for so many to understand what NVIDIA's CEO Jensen Huang calls the fourth industrial revolution. First being steam engines. Second, mass production, railroads. Third being semiconductors and personal computers. Welcome to the fourth. Those were all tectonic shifts in the way the world works. This is too. Hey, let me ask you something. If you were a seamstress in the 18th century, do you think you could have seen a steam-powered loom coming? If you were a blacksmith, could you imagine the railroads? When you were busy using an abacus, did you think about a personal computer? No, you didn't. You certainly never thought of an iPhone. Some of us lived through the rise of the PC and the internet. It was magical. The fourth industrial revolution, the one that's powered by NVIDIA and now AMD, the one that's being ushered in by the hyperscalers, is still hard for most people to understand. Later in the show, you'll see Rene Haas. He's the CEO of ARM Holdings, wearing some glasses from Meta that are like having a second, smarter brain within your first. Not to be confused with Steve Martin's The Man with Two Brains, which I like very much. You can speak to people in myriad languages. You can take pictures without being an intrusive jerk who whips out the cell phone at the most inappropriate of moments that I saw, like, for instance, last night when I was at Salesforce dinner. You can personalize an order from Williams-Sonoma so it knows everything you need. I know what you're thinking, small potatoes. It can't justify the trillions of dollars that are being spent on the data center build-out no matter what. That's why so many people believe this is a bubble. It doesn't help that some companies like OpenAI, the creator of ChatGPT, are spending money on all sorts of equipment that it seems like it's well beyond what they can afford, even if the company comes public with a $750 billion valuation. My best estimate for what if it does IPO, and it might IPO, we just don't know when. It's the cost of the build-out that's turning analysts and hedge fund managers into raving lunatic bears who are growling and clawing at everything in the AI food chain. They think the OpenAI is doing what's known as circular deals, which is a legal way of describing vendor financing, where a company offers money to a customer so the customer can afford to buy what the vendor wants to sell, something that only occurred near the top of the dot-com bubble in, say, 1999 December to 2000 March 3rd. Now, let's go back to the earlier industrial revolution. Let's talk about the rails. When the rails emerged, we had tons of railroad companies laying track all over the place. They overbuilt like crazy with borrowed money. Many of the individual rails collapsed, but the technology stuck around. And once the losers got wiped out, the winners won big. I believe that this is the right analogy for the AI data center build-out. You must ask yourself, would you at the time ever think that your horse would be replaced by an iron horse? Initially, most people said, hold it. So what? So what if it goes faster than my horse? But we still end up in the same place. I mean, what's the big deal? I am telling you, this is just the beginning. The build-out will have casualties. So did the rise of the railroads. So did the steam engine and the assembly line and the internet. But the people who built these had a vision like Zuck or Elon or Jensen or Sam or Andy or Lisa or Larry or the whole shooting match. Here's the bottom line. I can't ask you to grow your head. I wish I could. But I can tell you that these people behind the AI revolution, they're not clowns. They're not mountebanks. They're the best we have. You can question them, but my charitable trust is investing in them. After this trip, I definitely wouldn't bet against them. I'd choose one or two and hold on for the ride. Let's take calls. Let's start with Alexander in Texas. Alexander.
Booyah! Jim Cramer, how you doing?
I'm doing well, Alexander. How you doing?
Great. Hope those Eagles will get it next week.
The mini buy has helped. I could go into it, but it's just been painful right now. But let's talk stocks so I don't get depressed.
All right. So this stock pays a 4% dividend yield. It's near its 52-week lows. I want to know your opinion about Whirlpool.
It's kind of like the Bengals. Look, there's just not enough. The balance sheet's not that great. They had to cut the dividend. It's exactly the thing I am most worried about. A dividend cut means don't buy, don't buy, don't buy. All right, you can question the people who are heading up this AI revolution. Personally, I prefer to invest in them. On Mad Money tonight, from semis to coffee, I'm taking my time in San Francisco by taking advantage of all the West Coast has to offer. First, I'm sitting down with the CEO of ARM Holdings on the heels of its just-announced partnership with Meta. Then how is the turnaround at Starbucks really going? I'm talking to the coffee chain's CEO to find out. And I'm getting a read on the state of digital banking. Don't miss my exclusive with the red-hot SoFi. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Whenever I come out to San Francisco, I like to check in on some of the biggest stories in tech. Choices like ARM Holdings, that's the semiconductor design company that's been a juggernaut ever since it came public a little over 2 years ago. Earlier today, I got a chance to catch up with Rene Haas. He's the CEO of ARM Holdings to learn more. Take a look. Rene, you have made a deal. Now, it's a deepened strategic partnership with Meta. I think it is major. I think it is a market moving. Tell me about it.
We've worked for Meta. We worked with them for years and years and years. But today we're announcing a very large, broad strategic partnership, largely around data centers, but more broadly, Jim, around software and the software stacks associated with it. So in the data centers, increasingly they're moving to ARM in the data centers, whether it's general purpose compute or accelerated compute, things are doing AI. But also, you can see what I'm wearing today. These are the Wayfair glasses from Meta, amazing product, also ARM-based. And there's a lot of AI in these glasses. If you look at the next generation product, they're Hypernova. There's AI not only in the glasses, but AI in these wristbands that work back and forth. That's all ARM-based.
Well, let's talk about this, because I know that Mark feels very strongly that the glasses are the single best vehicle to get AI into your brain.
100%. They're talking about multiple millions of Ray-Bans to be sold by the end of 2026.
People think it's not market moving. I think that's insane.
And there's AI, Jim, not only running in the cloud, but there's AI running locally. And the magic is you want the software stack to be similar between what's running in the wearable and what's running in the cloud. Only ARM can enable that, and that's a big part of the announcement that was made today.
Okay, when I hear ARM and GPU, I worry about the place you used to work. I'm starting to think that NVIDIA is going to be obviated by you. I find that hard to believe.
In these next generation wearables, you're going to have AI processing running on small accelerators done by ARM.
That's
us.
you.
Yeah, and it's extremely low power. If you look at the power...
I should say they won't burn hot, or else we would get big sunburn rings.
These glasses are maybe a watt of power. A lot of that's consumed by the display, so you need ultra low power for the AI agent. And you want that AI agent to run locally. For example, when you say, hey, Meta, into those glasses, that's not happening on the cloud. That's actually happening in your glasses. And that's running on ARM.
Wow, so it's instant.
It's instant.
You can do all the things that my current ones do and not have sunglasses in a room, which always looks like it's a weird thing.
100%. And that's really why ultimately local processing makes sense, low power makes sense. But again, Jim, the magic of this announcement is the software that runs locally.
And that's you too.
Consistent with the cloud. Yes, and that's a big part of the announcement we made today.
Well, this is a major change of what I think about what ARM's doing.
a lot of people have a stereotype of kind of what we were and where we
That's
came
what it
from.
is. And I'm old school from the old days.
Not so much. And we've been evolving a lot as a company over the last number of years. And then, of course, as AI is making a big push to everywhere, we've evolved with it. AI is going to run everywhere. And AI needs to run in the cloud, but it also needs to run locally. And when it runs locally, you just can't consume power. That's where ARM is terrific.
Now, I have to imagine that this is something that you have to be working with at OpenAI on CPUs too, right?
OpenAI is a great partner. We do a lot of work with OpenAI. We haven't said very much publicly about the things that we're doing with them, but one of the things we can say is through Stargate, where they're using NVIDIA's Grace Blackwells, that's all ARM.
That's all you?
It's all ARM. It's all Grace's.
Okay. Well, how about Vera Rubin? Will you be in Vera Rubin?
Vera is ARM. So again, going forward, that will also be ARM based. And then, of course, Stargate, the big program between SoftBank and OpenAI.
Right.
And, I'm on the board of SoftBank, so we work very closely through that.
Why are they
OpenAI.
using your stock for a margin loan? I mean, they have all the money in the world, SoftBank.
SoftBank Mas is a very creative financier.
Yes.
He'll do all kinds of different things relative to maximizing his position to go off and spend money. So I don't think there's anything to see there.
All right. Now, I got nervous when I saw NVIDIA sit down with Intel, with Lip-Bu, and I want to know whether Intel's back in favor, and that may mean something that bodes poorly for you.
I don't think it bodes poorly for us. I think what Jensen said publicly about it with Lip-Bu is that this opens up one of the areas that Intel is strong in, and where ARM doesn't have great market share, is in the enterprise. But NVIDIA's commitment to ARM has been pretty deep, as we just talked about. Grace Blackwell, ARM. Vera Rubin, ARM. They just announced availability of DGX Spark, which is this small box that has 20 ARM CPUs with a smaller version of Blackwell for developers. So the relationship with NVIDIA has been never been stronger.
I need you to define and lend some color to what it means to not burn hot and the importance of not using a lot of electricity in an age where all I hear about is every time there's a big deal, big data center, I got to worry about nuclear power.
These multi-gigawatt data centers, 6 gigawatts, 10 gigawatts, every other day you're seeing these huge announcements. Over time, that is not sustainable. And you look to yourself, well, what are the kind of things that need to happen? I think there's two vectors to it. One is low power, the lowest power solution you can get in the cloud. ARM really contributes there. But I think even more specifically is moving those AI workloads away from the cloud to local applications. And you ask yourself,
like your glasses.
And what does that mean, local applications? That's inference. That's running the tokens. The training will always take place in the cloud. But the inference, and I ask a question, I want AI to solve it. Does that all need to happen 100% in the cloud? No. History has also showed us that we always go to hybrid models around computing. We'll see that with AI as well. And I think that will help alleviate just these huge investments in terms of all the power.
All right, now I need some truth telling, because no one tells the truth like you other than your football team. I pulled up with Sarah Fryer, CFO, and brilliant, and we all know her from OpenAI, but for other places where she's always been cutting edge. She said, look, the spend is justified. We have to do it. But then I put on TV, and all people talk about is circular, which you and I know is not true, particularly because if NVIDIA has a deal with OpenAI and the next big announcement is with Lisa Su, I don't find that very circular. Could you please explain to people that this build-out is right now worth taking seriously, and it's not just pie in the sky?
The investments we're seeing in these AI data centers are of a magnitude we've never seen before. And one can look at it and say, glass half empty, $300 billion of build-out with a $30 billion revenue stream. How does that come together?
People don't like that.
People don't like that. On the flip side, $120 trillion world GDP, AI being 5% of that, that's multiple trillions of dollars. Then you look back and say, you know what? It potentially is justified. The way I look at it, Jim, is this. 10, 15, 20 years from now, you can't make the argument that certain knowledge-based jobs, certain things will be augmented and or replaced by AI. That's just going to happen. The question will be in the near term, how quickly that happens, how it gets adopted, et cetera, et cetera. So we may be looking at micro bubbles or micro blips, but in the long game, AI is one technology that touches every piece of humanity.
So we will all become 120% of ourselves. What will happen? We all be better at what we do. We all will be smarter, because human capital is 50% of worldwide GDP. So it looks like that you could move the needle human.
I think it'll be a productivity gain unlike anything we've ever seen before, right? If you just think about helpers, things that can do legal reviews, translation, financial reviews, just things that augment. Humans still need to come up with the ideas. Humans still need to come up with the, what do I think is next? What do I need to invent, et cetera, et cetera. And I think so long as that is a human skill, AI is going to be a tremendous productivity helper. Hard to think 50, 100 years from now, a utopia where AI is thinking of all the ideas for us, and then we're not doing anything other than watching football and going to the beach. But I think that's quite
no, we want that's dystopian. Now,
that's dystopian.
the other day, an outfit, journalistic outfit, said that you're doing this deal with OpenAI, and the stock jumped to 190. When do we get away from the idea that every time there's a deal, your stock has to go up 10? I would like it to be that everything is the earnings go up. I don't want the press release to move the stock. I want the earnings. This is a problem that I see with Mark Benioff. When I see those earnings include a lot of generative AI, then I will pay a higher multiple. Yeah. When do we realize that it has to be earnings based? Because you've always understood the numbers.
Yeah, I can't comment on when someone writes an article about something that's going to happen.
Right.
I've always been of a philosophy of when we're ready to make an announcement on a product, we will announce it. It will be real, and we can back it up. So until that point, watch the earnings in terms of how ARM's doing, and watch our releases. We only release information when it's substantive and real, hence the Meta announcement, which we couldn't be so more proud of. They're a great partner.
Now, how does that come about? Does Zuckerberg call you and say, look, just come down here. We got to get this thing figured out. How does it work?
Yeah, I think it's probably more broad than that. We've been dealing with them for a long, long time, and I think if you look at their direction of travel, in other words, huge investment in data centers, huge investment at the edge, common software platform. How do I marry efficiency in the data center with efficiency at the edge with a common software story? That's ARM. So we had discussions with them about taking this to the next level. Santosh, who was quoted, was involved. Boz, Dave Werner, and of course Mark, who's a big fan. And I told Mark what a big fan I am of his product that I'm wearing.
I told him he said just gave me a heart, but I was overseas and I was able to speak with everybody, and I went to an arboretum in the Netherlands, and I saw every tree and what it was, and it was just kind of like 120% of me. That's what I felt like. I was me at another level, and I think people have to do this, put them on to realize that you can be you and be much smarter. And people miss that AI aspect. Now, is there any hyperscaler that you don't do business with? You're kind of Switzerland in this stuff.
There's nobody we don't do work with. Every major hyperscaler, whether it's Google, whether it's X.AI, whether it's AWS, whether it's Microsoft, OpenAI, they all use ARM.
All right, so let's just go back to basic. How much more of the PC, which, by the way, still sell?
Yep.
How much more of the PC can you take in terms of share?
Well, I think one of the things that's going to drive...
In server.
Yeah, so in PC and servers, so at PC, we've got Qualcomm, who's been a great partner so far.
Right.
There's going to be new partners coming out with chips very, very soon.
Which is amazing, because you fight them in court, and then you're still your partner, but I guess, look, you're a good guy. People like to partner with you.
They ship a lot of ARM products, and we're very grateful for that. NVIDIA's a great partner. There's a lot of other folks who are going to be shipping products into the PCs, and we're very, very bullish in terms of the growth area there. And then Apple, the other ecosystem, that's all ARM. Every Apple PC that ships.
And you recognize that Apple's doing far better than Wall Street understands, right? I mean, the creativity coming out of Apple is just nothing sort of stunning, and all people say is it's not doing anything.
And Apple has a loyalty to their product base unlike any other.
1.5 billion of us, right?
And they stay on the platform.
All right. Rene Haas is the CEO of ARM, and actually the man of the hour because of this Meta deal, but also because so many other deals, and he can explain anything to us. Rene, thank you so much.
Thank you.
Coming up, Cramer's sitting down with the CEO of Starbucks to see if his turnaround plan is brewing some positive momentum for the coffee giant. Next.
years since Starbucks brought in Brian Niccol, a proven turnaround artist, to take over the business. Since then, he's already made major strides in breathing new life into the story, although the stock's still struggling. There's been a lot of speculation about the value of the China business, Starbucks. The CEO now tells me it's expected to be north of $10 billion. That includes the upfront investment by a potential partner, with the company retaining a stake in the China business and the future royalty payments. Earlier today, we checked in with the man himself, Brian Niccol, the chairman and CEO of Starbucks. Take a look. Brian, are we back to Starbucks yet?
We are definitely closer than we ever have been, and I'm really proud of the progress we've made over the last year and the team that is executing against the plan.
You are innovating. We're all very excited about protein cold foam, but you are the keeper of the numbers. Is it working?
You know, as a matter of fact, I had a protein vanilla latte this morning, which was terrific. And I think you might have seen us talk about it. We had a great start with the launch. And I think it's really a function of we've made tremendous progress with our Green Apron service model. You know, we strengthened the operational foundation.
Can you explain it to people?
Oh, yeah, sorry. So the Green Apron service model really was all about putting more partners back in the stores. So you've got more partners that are now deployed correctly, and we changed the focus from tasks to customer service. And so what this is all about is when you walk into Starbucks, you should be greeted now from a barista. Right. And then also you should see the craft happen, and they should have the ability to give you a moment of connection, whether that's writing on the cup, whether that's, you know, saying, hey, have a great day, or just saying, Jim, here's your coffee. And then we've also started the process of uplifting our stores, which is returning the coffee house to a coffee house.
Third way?
The third place, have a great seat.
Right.
You know, if you want to hang out, great. But I think it's important that when people walk in, they feel like it's their Starbucks, it's their community Starbucks, even if you're just grabbing and going. But if you want to stay, there's a great seat. And so that's what the Green Apron service model was all about. And behind the scenes, you might remember I was talking about some technology.
Right.
We call it the Smart Queue.
Yes.
Which was all about basically sequencing the orders for our drive-through, the counter, and mobile order pickup. And the reason why that was important is it then brought, you know, order to those three access points.
We like empirical data, but Tim Cook told me that it starts with the anecdotal. Are you hearing from a lot of people saying, you know what, my store's starting to work?
That's exactly what we're hearing, Jim, is the number of emails and then people that just come up to me and say, hey, you know what, I'm noticing a difference in my Starbucks, whether it's the speed of service, whether it's the connection, and then obviously the physical environment when it changes dramatically. People get really excited. Both our partners get excited about it. They, you know, I think they kind of stand up a little taller when we ask our barista or our coffee house leader to actually be leading a coffee house. And then, you know, I happened to be in Austin recently, and I stopped by a store, and this woman, Melissa, the coffee house leader, there happens to be a group of gentlemen that show up every Saturday. And one of those gentlemen I knew from a prior life, he reached out to me. He's like, you got to stop by my Starbucks. you're not going to believe the difference that's happening. So, you know, those are the little stories that are happening. And what I love about it is it's happening all over the country.
Now, you close 1% of the stores. For some reason, people think that it's far more than that. You open stores, it just nets out -1. Are the stores that are closing ones that had minus comp sales, or were they just too gas station oriented?
You know, look, it was a combination of things where they weren't performing financially, and or unfortunately we had done some things to the store that no longer allowed us to be able to make it a great coffee house. And so, and a lot of those times, those things overlapped. Right. So, you know, it was really all about, do we believe we could get the financial performance back with this store? And could we give the partner and the customer the experience they want? If the answer was no to both, then it was time to actually close it. And to be honest, you never want to close a store. No. If there's any way to find the way to get it back to a great place of performance, we would have, you know, taken down that path. But in this case, it was just time for some of these stores. They needed to be closed. And, you know, not to say we won't be back in the trade area with a new execution.
Now, I think that you and I are both sports fans, and we're supposed to look forward, but never supposed to look back. But I was thinking about, it's been fiscal year 2022, 2023, since you had 4 consecutive quarters of up comps. Now, that means that things must have deteriorated at a much bigger rate than maybe we knew it's 3 years of destruction. Yeah. What happened in those 3 years?
You know, when I diagnose it, what it looks like is we probably were, you know, too focused on efficiency.
Okay.
And as a result, I think we over-rotated on the idea of equipment and then trying to figure out how you could operate the stores with fewer, frankly, partners behind the counter. And then that compounded with, I think, COVID, leading people to believe that the dining room or the coffee house seat or the third place was no longer important. So you had two things happen. One, and then obviously you also had some of the inflationary challenges where pricing, I think, got ahead of the business, combined with removing some labor and then pulling back on the thing that makes us unique, which is our experience.
Did people not think the comp store sales would go down if you do that, or did they think it would be kind of alchemy?
You know, look, my experience being in this industry for a long time is when pricing gets going and labor starts going in the wrong direction, it doesn't hit you right away. It's one of those things that slowly kind of builds the deterioration, and then all of a sudden it hits. And so, you know, we've course corrected. I think that's why you've heard me use the phrase back to Starbucks, which is, the good news is with our partners that are in the stores, they totally get it. They know exactly what I'm talking about. So all the folks in the store are genuinely excited of like, hey, this is great. My rosters are getting bigger. We're doing the coffee house walks. We know the 5 key moments. Like, we're going to greet people. We're going to give them great craft, and we're going to give them a moment of connection with a great seat.
Now, am I speaking too much about America? I mean, you and I have talked about China. China's much better, I think, than people realize in terms of an asset, correct?
Yeah, look, the China team has done a nice job of getting that business back, I think, on its front foot. You know, in our most recent quarter, we talked about we had transaction growth and ultimately comp growth. We've done some things with innovation, menu architecture, but the business continues to perform, and I think they're continuing to work their way back to the performance that we know they're capable of.
Now, the European stores tend to be in incredible locations and are almost shrine-like.
Beautiful.
Yeah, and that never went bad.
No. I would say a lot of our European partners, because remember, a lot of our business internationally is a licensed relationship.
Correct.
So we've got great partners like Alshaya in the Middle East. Alsea participates in Europe and Mexico, and they never slow down on having a great experience with a great store. And you know, fortunately, as we've gotten the brand narrative back to being a great coffee house focused on a third place, we're seeing those businesses respond too.
Airports, I know licensed. The previous 2 CEOs told me, Jim, it's licensed. There's nothing I can do about it. It's like, forget it, Jake. It's Chinatown. I can't believe you'd let that happen.
Look, I don't agree with that. We need to make the experience in the airport better. We're not where we need to be yet.
No.
With the most recent restructuring, we've done some work on how do we work with our licensed partners differently. And actually, we've got our U.S. licensed partner summit happening in Seattle next week. And we're going to talk about how do we get back to being a great experience, whether you're in the airport, whether you're in, you know, the grocery store, a Target. We want a great Starbucks experience, and you shouldn't have to decide whether it's licensed or a company-operated store. It should be no different to our customers.
Exactly. Now, when I went to one of the annuals, Howard Schultz introduced people a way to go to college. Now, a lot of that, some people might have thought was you did it because it was family. Some people thought, look, there's no union because it is kind of family. Where are we in making it so the baristas feel better? And I know that a lot of people were saying, listen, for the 900 people that you laid off in the central office, they all got good severance packages, as you even said in your note. But how are we treating the baristas? Because those are heart and soul.
Without a doubt. And, you know, I would tell you, first of all, those store-level employees that were impacted, we also set them up with a severance package, which is out of the norm for the industry. And from day one, I've said we want to have the best job in retail. And I really do believe we do.
Equal to Chipotle, because we know that Chipotle was the best job in retail.
You know, look, it's one of my personal passions.
Absolutely.
So wherever I am, I want to have the best job in retail. And, you know, our turnover now, Jim, is lower than 50%. Which in this industry, you got to remember, most, you know, would love to be below 100%. So the fact that we're below 50 tells you we're doing the right things. The other thing too is we've done a lot of roundtables, and meaning we just get together and have a conversation and hear what's going on, and then we obviously survey the entire system. And our partner engagement scores are at all-time highs. So they're seeing the effects. Because remember, in August, we rolled out roughly over $500 million of investment into the stores and into our partners. And we're not slowing down on this idea of We want to set you up for success in your job, and then we want to set you up for success if you want personal development as well. And that's the college program you're talking about, which is a tremendous program. I've had the opportunity to go to a couple graduations, and those are tearjerkers.
All right, last thing. My charitable trust has a big position, and the reason they're twofold. One is that I used to go, and now I'm back. But the second is because of you. Oh. Where is it versus what you expected? How disappointing was it versus what you expected? And how long can we be at the $80, $82 level before people say, you know what, I thought he could pull it off, but maybe he's not the guy?
Yeah, look, I will tell you, first of all, I think more people are doing what you're doing right now, which is they might have left us, but they've come back.
Yes.
And they've experienced the Starbucks that I think they actually cherished before we maybe had some missteps. And I will tell you, I think we're ahead of schedule on the turnaround. That's part of the reason why we leaned into launching the Green Apron model sooner and faster. And I just fundamentally believe as we continue to make progress and the results, I think, follow the stories that I'm sharing, the stock will take care of itself. Right. And I've always taken that approach, which is if I take care of all the key constituents, meaning we do a great job for our customers, we do a great job for our partners, and we're unrelenting on execution, good things follow. And I'm delighted to hear that you're back.
I am back.
And hopefully,
and I'm back with the triple venti cappuccino with skim wet, and they actually take the order. They don't look at me like I have three heads.
Well, and I think one of the things, it's really been interesting because when I came in, you hear what are the challenges, and really what they were telling me is like, look, in order for me to pull off the personalized coffee, like you just rattled off, I got to be staffed correctly. Right. I need the right process. Right. It's not that it's not feasible for me to do. It's not feasible to do the way you're setting me up right now. And so I took that to heart, and I was like, all right, we're going to fix that because, look, the reason why you love Starbucks is because you can personalize it the way you want. And we need to be able to set our partners up to give you that personalization.
I want to thank Brian Nichols, CEO of Starbucks, who a lot of people bet against. People forget what it was like at Chipotle before he came. I was critical too, but I was converted, and I was right because you're that good. Thank you, Brian.
Thanks, Jim. Yeah, pleasure.
Coming up, SoFi has gotten its gains right in 2025 by rallying to new all-time highs. And Cramer's sitting down with the CEO to see what's behind the move higher. Next.
Look, since we're here in San Francisco, I want to catch up with SoFi, the digital bank with a stock that's taken the world by storm. Do you know this is up more than 80% year to date, largely because they won the trust of the younger generation, but it's going to be bigger than that soon, so can it keep running? Let's take a close look with Anthony Noto. He's the CEO of SoFi and a longtime friend of the show. Mr. Noto, welcome back to Mad Money.
Thank you, Jim. Thanks for having me.
All right, so what has been the key? This has been the move that you and I both expected, that I banked on you to do. You delivered. What is the genesis of it?
The first key is that we're building a relationship with our members. We're trying to be a one-stop shop for all their financial services needs. We want to be there for every one of the major financial decisions they make and all the days in between. And so we have all these products that can help them get their money right by helping them borrow better, save better, spend better, invest and protect better. We launched all of those products in 2019 and 20, and we just have been building trust and awareness over the last 8 years, and it's really continued to drive really strong revenue growth, member growth, which allows us to reinvest in the business, and most importantly, drive continuous responsible innovation. A lot of companies drive innovation, but it's not responsible innovation.
Well, let's talk about that because there is such a propensity to do innovation, but some of it is self-destructive, and people will say, listen, I want to be 3 times X. They should go. DraftKings has stuff like that, right? And you can limit your losses, but that's not the goal of a good bank.
Yeah, one thing that's paramount to our business is trust. We need our members to trust us to give them great products that are superior to other products, be reliable, and be there when they need us. And so our SoFi Money account is the best of checking and savings in one account. High interest, the ability to send money any way that you want. We're introducing being able to send money internationally through the blockchain. SoFi Invest, the only place you can buy single stocks, fractional shares, SoFi
pioneered
ETFs.
fractional shares, something we really like.
We did. We pioneered fractional shares. A lot of people don't realize it because our members were buying stocks that were less than $10, but they weren't buying stocks.
I shouldn't be laughing.
They weren't buying stocks that were appropriate for their age. They were buying Ford and General Electric. And we realized that. We decided to make high dollar stocks like an Amazon or a Tesla available at $10 at a time. And we also introduced a few ETFs at a $10 price point for 500 diversified companies in one ETF with very low fees.
That's the kind of creativity I like, because what it does is it gets people, particularly young people, inspired to invest. There's nothing wrong with trading. I did trading, you know that. But what if you're professional? If you're not a professional, as you might say, that's not as responsible as investing for the long term.
That's exactly right. And we want to make investing more accessible to Main Street. So we've done IPOs at IPO prices. We just did a couple of private placements in private companies like SpaceX.
Fantastic.
And in addition to that, we just launched
SpaceX. People should know that's a big deal to get into.
Yes, sir. It's not easy to get access to that, and we've provided that as well as Databricks. And then most recently, we announced launching an agentic ETF to give people an opportunity to invest in a diversified way in that theme, but also to dollar cost average, which is also important to diversification.
Now, you've got something that I think people have worked hard are not respected by the banking system. You've got a subscription product that would make it so if someone, let's say, saves $100,000, which is unfortunately not a lot in these Wall Street firms, they'll get treated with respect, which is what they deserve.
SoFi Plus is about taking the best of SoFi, bringing it together, and giving even more value to our members. It's the most valuable subscription in financial services. It's $10 a month. It gives you a very high APY in your checking savings account. You get boost on rewards. In addition to that, you get access to unique things like events, in addition to the fact that you'll also be able to have a free certified financial planner. And we'll add more and more into that subscription product, including a smart card in 2026.
You know, when people say, bear with me in this analogy, when we see driverless cars, we realize, Jesus, maybe a human should never have been driving them, because it turns out they have far fewer accidents. They don't drink. They don't get tired. I often think that your model is the model that we would have chosen had we known that it could even be creatively available.
Sure, absolutely. The idea for SoFi and SoFi Plus generally was about how do we help people get to the point they have enough money to live their dreams, to have the size house they want, the size family. Well, you can't save your way there. You have to actually spend less than you make and invest the rest, which means we have to be in all these different products. And our message of get your money right is really about getting that formula correctly. And if we have all these products, we can be there when you need us, and we can be there before you even know that you'll need us. And SoFi Plus is a way to bring that in a unified way with the maximum value you can get from SoFi.
All right, let's talk about crypto and options. If used incorrectly, we've seen a lot of people lose money, as they did last Friday when you had a sudden drop-off. If used correctly, I think that they're a great insurance against $37 trillion in debt. You are not a fan of that number, I know. Tell us about how you got back in and you like crypto because the members want it. You want to do what the members want. And give us a little sense of stablecoin.
Sure, absolutely. When we first launched SoFi Invest back in 2019, we asked our members what they wanted to be offered to them. And we offered them cryptocurrency in a very responsible way. We gave them warnings that it's a risky asset, is unproven, they could lose all of their money. And they loved having the product. When we applied for a national bank license, we lost the ability to offer cryptocurrency. But this spring, much to our delight, we actually now have the best license to be able to offer not just banking products like SoFi Money and our credit cards and our loans, home mortgages, et cetera, but now we can also offer buy, sell, and hold crypto in a responsible way to educate them. We'll also offer a stable coin to allow money to be moved internationally and domestically faster, cheaper, and in a more secured way. We believe blockchain will fundamentally change the way finance is done throughout our country and the world, and we're going to use it to give our members great value and how they think about the options they have, but will also be used underlying in the infrastructure to move money faster, safer, and
let's talk about faster. When it's a real pain in the butt to do crypto in the banks that I deal with. There's a delay. You want to go do crypto? No, forget it. You got it. It's like 24 hours of processing, then another 24 hours of paperwork, and we never know what the heck's going on. Let's say I watch the show and I say, you know what? I want to buy crypto. I'm going to call this guy's bank. How quickly can it happen? How quickly can it happen?
Sure. We'll be launching it before the end of the year, and it can happen very quickly. Because we're a bank, you'll be able to fund your checking or savings account instantly and be able to buy off of that deposit base that you've put cash into instantly.
And how about if I want to put it in stablecoin?
you'll be able to do that as well. We'll introduce stablecoin in 2026, but you'll be able to do those things as easily as moving money around or buying single stocks.
Why is it that others don't do that?
Well, many others are not banks, and so they actually have to create relationships with third parties and other entities,
yes, that's true.
Which makes it very complicated. The thing that's great about our business is we really want to own the member, but we also want to own the experience. We want to own the technology, so we're responsible for delivering it, and we own the best regulatory license we could have in a nationally licensed Tier 1 OCC bank.
You offer a great rate. Do you think that rates are that they'll be able to cut rates, say 3 times next year? You have a good handle on what people are spending.
Yeah. We do think rates will come down. As we've talked about, we've maintained very strong growth. Our outlook continues to show mid 30% growth or higher. We've been able to actually deliver more than the rule of 40 for 16.
Yes, I forgot to ask you about rule of 40.
So the rule of 40 is revenue growth plus EBITDA margin, and last quarter we were actually over 60. But for the last 16 quarters, we've been over 40, and the average has been in the mid 50s.
I have no idea why anyone would bet against a company that does rule of 40. Now, a lot of people still associate with the old days about student loan. I think about unsecured loan and what you're doing there. But what is the temperature of that market?
We continue to see very strong demand for people refinancing out of expensive credit card debt that's in the 20s into our unsecured personal loans with rates in the 11 to 12% rate. That product has been a big growth driver for us. We're a lot less dependent on lending now. It's less than 50% of our business.
Right, student loans no longer
and so,
really.
We're growing not just based on our capital, but based on our ability to offer all these products that have fees. So really strong demand for the loans. Credit's performing really well. We think rates will go down, which will be a tailwind to a number of our lending businesses, as well as the investment.
But I'm still
business.
glad that I regard you as a fee-based business, which gives me a little security, which is one of the reasons why when it was at 5, I had no problems recommending it.
Exactly.
All right. That's Anthony Noto, the CEO of SoFi, and yes, indeed, an old friend of the show. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. Turn the light round, Chris. Everybody, that's wrap for closing. Say something better. Buy, sell, just because it's cause fast time. My step for Instagram, so apply your plan to sell. And then the lightning round is over. Are you ready, Ski Dad? Time to load down, Chris. Everybody, start Jonathan in Georgia. Jonathan.
Booyah, Jim. I'm Jonathan from Sandy Springs, Georgia. First-time caller, long-time listener, 18 years and counting. I'm calling about CRH, a world leader in building materials for infrastructure.
It's as hot as a pistol. We know that is the area that is holding up fine, despite the fact that there's no housing to speak of. Great call there. Let's go to Dave in Illinois. Dave.
Dr. Cramer, my good mad friend, how are you?
I couldn't be doing better. How about you?
I'm great. Jim, your thoughts on Cloudflare?
I know it seems high in the 200s, Dave, but you know what? We are a big believer in Matthew Prince, and we're not stopping here. We're going to continue to support him. Maybe take some off the table at first point at 60. Let's go to Jimmy in Pennsylvania. Jimmy.
Hello, Jim Cramer. Booyah.
Booyah. I could have been Jimmy from Pennsylvania. That's what Mom called me. What's happening?
Hello, I'm actually, you can call me Mo from Frontier Lumber, Erie, PA, on 5th Street. Okay. You should come by. But my stock today is about Red Cat.
Okay, so this is a Ben Stoto favorite. Not really. It's a drone company. We are on the fence about buying drone companies that aren't making money. So I'm going to have to say, and that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
I like to say there's always a bull market somewhere, and I promise to try to find just for you right here on Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.